So, Mike, it's great to have you. I'd love to have you bring us up to speed on what changed in the bill.
Yeah, great to see you, Leslie. Thanks for taking the lead here today. So the bill, I'm going to call it the bill. Doesn't roll off my lips very well, my tongue very well. Um, the the bill makes Section 163J business interest expense add backs permanent. It's the EBITDA add back permanent when computing your 163J business interest expense disallowance. You'll recall back in 2020, for tax years in 2022, you really were no longer allowed to add back depreciation and amortization to your tax base when computing that disallowance. It was 30% of adjusted taxable income. The tax bill actually allows, on a permanent basis now, an add back of both depreciation and amortization. So that increases the tax base, which in turn increases the amount of interest expense you can deduct under 163J. That's for tax years beginning after 12/31/2024. So if you're a calendar year taxpayer, it's something to consider for 2025. In addition to that, the 163J was modified to essentially subject capitalized interest to the 163J disallowance calculation, most capitalized interest. This is essentially shutting down a tax planning strategy that some taxpayers were pursuing to try to do an end run around the 163J limitation. This provision applies for tax years beginning after 12/31/2025.
Yeah, so I think that's a really good overview of that provision. And so, if you were thinking about how you might manage that, especially considering all the other changes that Mike talked about, what are some key planning opportunities to consider?
Well, to a certain degree, it's kind of back to basics on some level. Go back, taxpayers might want to go back and see if they qualify for one of the exemptions. There's the small business exemption, which exempts taxpayers who have revenues below a certain threshold. If you're a real estate property trade or business company, there could be an exception for you as well. Absent being, qualifying for one of those two exceptions, now you kind of sharpen your pencil and start doing some tax modeling. So one idea might be, does it make sense to actually deleverage your capital structure, right? Maybe you fund projects with equity capital rather than debt and kind of reduce the amount of interest expense on your P&L. Another idea could be maybe kind of scheduling out your deduction flow for the next few years to figure out whether or not it might make sense to push some of those deductions into next year to free up taxable income and in turn increase your interest expense limitation. So those are a couple of kind of basic strategies you consider, but I think like a lot of what we're talking about here, Leslie, modeling is key.